Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 1st of October 2018 and we're briefly covering issues relating to China and their potential impact on gold and silver prices. Now before we discuss this, we have to admit that there are many influences on gold and silver prices and no single influencer totally determines their price. One of the largest influences at present is of course the value of the US dollar, as internationally gold and silver prices are denominated in dollars. Now today we're going to discuss some recent developments in China and the influence these are likely to have on gold and silver prices. Now please be mindful that whether these have a positive or negative influence does not mean that we believe that this influence is going to determine their overall price, but will nevertheless be one of the many influences. We truly believe that the more aware you are of these events, the better the decisions you can make for yourself in determining whether to buy gold and silver or not. The decision is always yours and should always be yours. The reason we are covering China is multiple-fold, but especially as it's the second largest economy in the world, and according to official figures, and we all know these are understated to some degree, is the sixth largest holder of gold reserves in the world. In addition, along with countries like Russia and India, is in the top tier of current gold and silver buyers. Okay. So now let's take a look at what has been happening lately. The latest PMI surveys confirmed that the weakness in China's manufacturing sector was accelerating. For clarification, PMI, Purchasers Managers Indexes, are economic indicators derived from monthly surveys of private sector companies. According to the official NBS manufacturing PMI, which was released on Sunday, sentiment dropped further in September, despite what has been a mild upward seasonal bias in recent years. All sub-indexes showed weaker growth momentum. The Caixin manufacturing PMI also declined in September, reflecting the nation's economic slowdown and fallout from the trade war with the United States. The NBS non-manufacturing PMI was stronger, however, due entirely to a surge in the construction PMI. But China's NBS manufacturing PMI fell to 50.8 in September from 51.3 in August and was the first September drop since the NBS manufacturing PMI series was released. In addition, in looking at the components, all the major sub-indexes showed weaker growth momentum in September. IHS Markit APAC chief economist Rajiv Biswas stated, quote, "The further slowdown in China's official manufacturing PMI in September reflects the intensifying impact of the US-China trade war on China's manufacturing export sector. The near-term outlook for the Chinese manufacturing export sector remains weak, albeit the Chinese government may apply some further stimulus measures to support growth," unquote. China's officials have promised fiscal stimulus in the form of tax cuts and infrastructure spending to buffer the domestic economy somewhat from the effects of the trade dispute. Analysts also expect China's central bank will continue increasing liquidity in the financial system to support economic growth. It is interesting to note that China's modest growth slowdown is a sharp contrast to the sharp upturn in US growth, which has helped to explain why Chinese stocks have fallen into a bear market while the US has hit record highs, and why President Trump continues to press China on trade concessions. After all, he is confident that the US is winning the trade war. So we can see immediately that China, through its equivalence of what we in the West understand to be QE, may once again be borrowing more money and thereby reducing the value of its currency to assist in preventing these ailing industries. In addition, and possibly ultimately, the biggest risk to China is whether the ongoing slump in the credit impulse accelerates. Some analysts believe that the credit impulse is about to plummet and that China is about to unleash the biggest global recession since the financial crisis. For your information, the credit impulse is a term coined by Michael Biggs, then an economist at Deutsche Bank, when, in 2008, he defined it as the change in new credit issued as a percentage of GDP. Why do we mention this? Well, according to research firm Rhodium Group LLC, there have already been at least 14 corporate bond defaults in China in 2018. A high number for a country which until recently had not seen a single corporate bankruptcy, and a number which is set to increase as Chinese banks pull back from lending to other firms that use the funds to buy bonds, exacerbating the pressure on the market. Beijing's crackdown on China's $10 million shadow banking sector has caused strains to spread from high-yield trust products to corporate bonds, as the lack of shadow funding has choked off refinancing for weaker borrowers. Separately, banks lending to other financial firms, a common route for funds and securities brokers to add leverage for corporate bond investments, has continued to decline since reaching a peak at the start of 2018, and is now down to the lowest level since late 2016. So what impact does this generally have? There are many, not least of which is their effect on the value of the Chinese yuan, and the potential decline in its ability to continue to import the high levels of gold and silver it has achieved in recent years. More importantly, of course, is the potential collapse of their bond market, and not to mention the added pressure experienced by a continuing decline in the Italian bond markets. And even this morning, India's government announced that it would immediately seize control of a shadow lender whose defaults have caused widespread upheaval at mutual funds. So we are witnessing potential bank failures. And although these aren't directly related, they do suggest a potentially systemic problem within this sector. So on the one hand, we may indeed witness a decline in demand for gold and silver by China, but a potential crisis in the bond markets worldwide, which could cause investors to flee to gold as a safe haven investment. Our view is that at present, these are just warning signs, and that these problems, short term, can be overcome. But longer term, there is little doubt in our minds that these crises will occur and accelerate, and then precious metal prices will ultimately benefit. Certainly from an investor buying point of view, even though potentially industrial demand may be adversely affected as the world's economies enters into a recessionary phase. Just for interest, at the time of producing this video, gold is down just $2 at $1,189, and silver is down 10 cents at $14.56. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on Twitter. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we're not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.